All right, welcome class. In today's session, we're going to break down one of the most critical concepts in all of Canadian corporate tax, the Canadian-controlled private corporation, or as you'll always hear it called, the CCPC. So let's get started. Here's our game plan for today. We're going to start with the absolute basics, what a CCPC even is. Then we'll jump into its biggest, most important advantage, the small business deduction. After that, we'll get into the weeds on the two major limitations you have to know. And finally, we'll round things out with some other key benefits and see how this all trickles down to the shareholders. Okay, let's dive right in. First things first, what exactly are we talking about when we say CCPC? And more importantly, why should you care? Well, you should care because of this. The numbers on this slide tell the whole story. The entire point of the CCPC rules is to give small, private Canadian companies a major tax break so they can reinvest their profits and grow. Just look at the difference. A qualifying CCPC in Ontario pays a combined tax rate of around 12.2% on its first $500,000 of active business income. A regular corporation, they're paying 26.5%. That's more than double the tax rate. It is a massive, massive advantage. So how does a company get access to this incredible tax rate? Well, it has to meet the definition of a CCPC laid out in the Income Tax Act. It really boils down to these three simple-sounding but very strict conditions. 1, it's got to be a private corporation. 2, it's got to be a Canadian corporation, so incorporated here. And 3, and this is the big one, it cannot be controlled by non-residents or by a public company. And that brings us to the main event. The reason we care so much about CCPC status is almost entirely because of this, the Small Business Deduction, or the SBD. This is the crown jewel, the single most important tax perk for any CCPC. The SBD is what creates that low tax rate we saw, and it applies to the first $500,000 of active business income a company earns each year. Now, this is a critical point that you need to remember. If you have a group of companies that are associated, meaning they're controlled by the same person or group, they have to share this $500,000 limit. You can't just set up 10 companies to get 10 deductions. The government's wise to that. Okay, so as you can imagine, this deduction is incredibly powerful. But it's not a free-for-all. The government has put two major roadblocks in place to make sure this benefit actually goes to small businesses. The first one is a size test, and it's based on something called taxable capital. Think of that as a rough measure of the company's economic size. It includes things like shareholder equity, retained earnings, and long-term debt. So this raises a really important question, right? What happens when one of these CCPCs does really well? It grows, it reinvests, and its capital base gets bigger and bigger. Does it get to keep this amazing tax break forever? The answer, as you might guess, is a firm no. This is where the government steps in. The SBD limit gets ground down. That's the technical term you'll hear. It gets reduced dollar for dollar once the taxable capital of the corporation and its associated group gets too big. The whole idea is to gently phase out the benefit as a company matures. And this is where things get really interesting, because this rule changed in a big way a couple of years ago. Before the 2022 federal budget, the SBD started to disappear once a company hit $10 million in capital, and it was completely gone by $15 million. But now, that phase-out range has been stretched all the way from $10 million to $50 million. This was a game changer for a lot of medium-sized Canadian businesses. Let's put some real numbers to this, because this is where you can see the impact. Take a look at that $15 million line. Before 2022, a company with that much capital got zero SBD. Their deduction was completely gone. But under the new rules, they still get access to an SBD limit of over $437,000. That translates to more than $26,000 in federal tax savings that just didn't exist for them before. That's a huge deal. All right, that was limitation number 1, the size test. Now let's get to the second major hurdle. This one isn't about how big the company is, but rather what it's doing with its money. It's designed to stop companies from acting like personal investment holding companies while still getting the small business tax rate. So think about it. The government wants to incentivize companies to reinvest in their active business, hiring people, buying equipment, expanding operations. What they don't want is for a company to just take its profits, park them in a big portfolio of stocks and bonds, and earn passive investment income while enjoying that low SBD tax rate. And the way they prevent this is, Well, it's pretty aggressive. The rule looks at the passive investment income of the corporate group. Once that income crosses a $50,000 threshold in a year, the SBD limit for the next year starts to erode. And the formula is harsh. For every $1 of passive income over that $50,000 limit, you lose $5 from your SBD limit. It doesn't take long for it to disappear completely. Once you hit $150,000 in passive income, the SBD is totally gone. Let's run a quick example so this really sinks in. Let's say a company's group earns $100,000 in passive income 1 year. That's $50,000 over the threshold. So we take that $50,000 excess and multiply it by 5. That gives us a reduction of $250,000. So, in the following year, their SBD limit is cut in half, dropping from $500,000 all the way down to $250,000. You can see how quickly this can bite. So here's the final kicker on these limitations. You have the size test, and you have the passive income test. Both can reduce your SBD. So which reduction applies? Well, the rule is you have to calculate the reduction under both tests, and then you have to apply whichever one is greater. In other words, whichever one is worse for the taxpayer. You don't get to choose. Now, the SBD is obviously the big kahuna, it's the headliner, but that's not the only perk of being a CCPC. Maintaining that status unlocks a whole suite of other advantages that you really need to be aware of. These are all super important. For innovative companies, CCPCs get a much better, refundable 35% tax credit for their research and development spending. For the shareholders themselves, there's the lifetime capital gains exemption, which can allow them to sell their shares completely tax-free up to a massive limit. For attracting talent, employee stock options in a CCPC get very favorable tax treatment. And just for day-to-day cash flow, some smaller CCPCs can pay their income tax in quarterly installments instead of monthly. It's a really powerful toolkit. Okay, last piece of the puzzle, everyone. We've talked a lot about the tax the corporation pays, but what happens when the owner, the shareholder, wants to actually take that money out of the company and put it in their own pocket? This brings us to a fundamental concept in Canadian tax called integration. The goal of the system is to make it so that, at the end of the day, the total tax paid, both by the corporation and the individual shareholder, is roughly the same whether you earn that dollar directly or through a corporation. Here's how it works. Income that was taxed at that low SBD rate inside the company comes out as what we call a non-eligible dividend, and that gets taxed at a higher rate on your personal return. Income that was taxed at the high general corporate rate, that comes out as an eligible dividend, which gets a much better tax credit and is taxed at a lower personal rate. It's a balancing act. So let's wrap all this up. What's the big picture here for you as a student of tax? The CCPC status and its small business deduction are an absolute cornerstone of our tax policy. They are specifically designed to give small, private Canadian businesses a leg up. But as we've seen, this incredible benefit is surrounded by fences, complex rules based on size and passive income, to make sure it's not being misused. As a future advisor, your job is going to be to understand this intricate dance between the incentive and the limitations. It is absolutely essential knowledge for advising any private company in Canada on how to structure itself, plan for growth, and meet its tax obligations.